Hello. I'm very glad to be able to speak in the IGC South Asia conference. I wish I could have been there, but we are in the middle of term here, so it's not possible to get away. So, the title of my paper is Agent Intermediated Lending, a New Approach to Microfinance. My co authors are Pushkar Maitra, Shondeep Mitro, Alberto Mota, and Sujata Visaria. We start with some background motivation. We all know that growth and poverty reduction are key economic policy goals in India, and recently the control of food price inflation has also been a challenging problem. So we need to find ways to encourage poor farmers to increase the cultivation of cash crops. Now, in this regard, financing constraints are a key problem because the poor are unable to access credit from formal financial institutions because they lack collateral. And microfinance has not succeeded either in financing cultivation needs of poor farmers for a variety of reasons. The most important is that the way microfinance has traditionally been structured, it has very high frequency repayment requirements, which makes it very difficult for farmers who are planting crops uh, which will generate a yield a few months from the time of planting, would not be able to meet those frequent weekly or monthly financing requirements. Besides, microfinance institutions are extremely concerned about making sure that repayment rates remain high so they discourage risk taking by their borrowers. And this is accentuated by the reliance on joint liability loans, where the MFIs lend to groups, and the peer members, other members of the group, then are checking whether borrowers are taking a lot of risk and try to discourage it. Now, a variety of other concerns with microfinance have arisen in India. The Reserve Bank of India set up a Maligam committee which filed its report in 2011. And the main concerns expressed by the committee about microfinance institutions and their functioning in India is that they charge high interest rates, they encourage overborrowing by clients, they utilize coercive recovery practices, and sometimes they poach clients from self-help groups who are borrowing directly from banks. The mean interest rate that MFIs charge, according to the Malagam Committee, is 37% in India. And this is extremely high compared to 12% rate on average paid by those people who access co-op or formal bank loans. So you see a margin of about 25% uh, above borrowing costs. And the breakdown of this is between administrative costs and profits, about 14% is accounted for by administrative costs. So these administrative costs are pretty large. And that leaves about 11% profit for the MFIs on average. So the new Reserve Bank of India regulations, which have been introduced recently on the basis of the recommendations of the Maligam Committee, have imposed an interest cap of 26% as against the average interest rate of 37% that were being charged previously. And they also impose a cap on the margin of 12%. And as you can see, with 14% administrative costs, it's very difficult for MFIs to continue to lend on the basis of their traditional practices. So there's a need for a new kind of microfinance for these reasons. And the Maligam Committee also recommended that the rural sector lending by by Indian banks should be reoriented towards self-help groups that would be financed directly by banks. And to facilitate this, banking correspondents and facilitators could be appointed from the local community that would be acting as intermediaries. Now, our approach is pretty much along these lines. Our approach relies on intermediaries who are informal traders and lenders that are chosen from the local community. And in the experiment, we choose them randomly. So we select people who have extensive experience of lending to poor clients in the village. And the role of these agents is to recommend 30 clients for trail loans in each village. And they have to recommend clients who own no more than 1.5 acres of cultivable land. Of the 30 clients who they recommend, we select 10 out of them randomly to receive the loans. Now, the agents are incentivized by commissions. They receive 75% of the loan repayments. In addition to that, they pay a 500 rupee deposit per client, which they would forfeit in case the client defaults. And if the average repayment rate of all the clients recommended by an agent falls below 50%, the agent gets fired. And the main idea of this scheme is you want to harness the local information that is available to the agent from prior experience in lending in the village to select good borrowers. And we also incentivize them to make sure that these are the good borrowers and that they will repay their loans by the commissions, which are based on loan repayments. Now, the trail loans are also structured in ways that are quite different from traditional microfinance loans in order to facilitate borrowing for agricultural purposes. Uh, so the trail loans are individual liability loans, they are not group loans. They have a longer duration of repayment of 4 months. So this would enable the borrowers to finance the cultivation of most crops because the planting, the crop cycle for most crops is of the order of 2 to 3 months. So this would give farmers the opportunity to borrow at the beginning of the planting season and repay after the harvest. The interest rate charged on these trail loans is 18%. So you can see these are about half of the average MFI interest rate of 37%. Trail loans require no collateral, do not require any savings by the borrowers. There are no group meetings, there is no monitoring whatsoever by bank or MFI officials. The loans have also built in a feature of insurance against covariate risks, where the repayment liability is reduced if more than 20% drop in crop price or local yield for the crop in question occurs. And to give the borrowers a strong incentive to repay the loans, the credit limit in the next cycle is increased to 133% of the current loan that is repaid. Now, we use group loans as a control in the experiment. So we conduct this experiment and compare the trail loans in some villages with group-based lending in other villages. And in the group-based treatment, which we call GBL, joint liability loans are given to 5 member groups. The groups that are eligible must be composed of members who do not own more than 1.5 acres of cultivable land. And just as in standard microfinance practice, group members must meet savings requirements and attend frequent group meetings. But in all other aspects, the GBL loans are the same as in trail. There's an 18% interest rate, which is much lower than traditional microfinance loans. The duration is also 4 months. And again, the credit eligibility of the group is 133% of the current repayment. And we also have the insurance feature against covariate risks. Now, the setting of the experiment is in West Bengal in 2 districts, Hooghly and West Mednipur, where potato is a leading cash crop. And we were hoping and expecting that these loans would encourage the cultivation of potato. So 24 villages were selected for trail and 24 villages for GBL. There was a third treatment called GRAIL, where the agents were people appointed by the local government. But in what I'm going to talk about now, I'm not really going to talk about GRAIL. I'll just compare trail with GBL. And these trail and GBL villages are randomly chosen, so they end up being divided equally between the 2 districts. Now, within each trail village, 10 out of 30 eligible borrowers are recommended by the trail agent, and they receive trail loans. The amount was, when the experiment started in October 2010, it was relatively low compared to what they normally use. It started at 2,000 rupees, but because of this credit expansion feature based on current repayment every 4 months, this expanded to about 8 or 9,000 rupees by the end of 2012. In each GBL village, groups were invited to form, and of the groups that formed, two are chosen randomly, and so each group has five members. So you also get 10 people in each GBL village getting loans. Now, the scheme started in October 2010. It continued till the end of 2013, but I'm going to talk about the data that we have until the end of 2012. While it was going on, we did a farmer survey in each village with a sample size of 50 farmers in each village, of which there were 10 that received the loans, so we call them the treatment group. 10 that were recommended or formed a group, but they didn't get the loan, and we call them control 1. And we also have 30 households or farmers that were not recommended or were not eligible for the group loans. Of course, we restrict ourselves to households who do not own more than 1.5 acres of land. So this design enables us to separately estimate the treatment effect by comparing the treatment group with control 1 and separating it out from the selection effect, which is the difference between control 1 and control 2. Now, the theoretical predictions of a model that we develop in the paper that we would like to test is that the high commission rates for trail agents will induce the agents to recommend borrowers who are safer and more productive than average, and that they will also be they're more likely to recommend borrowers from amongst their own clientele. There's going to be no such selection pressure in GBL because riskier and less productive borrowers may have, in fact, a stronger incentive to apply for GBL loans. And there's nobody else in the village who's exercising any restriction on these borrowers from joining. Now, it turns out most trail agents are not low cost, and they are also likely to prefer clients who own some land because such clients are more likely to be productive. So as a result of this, we expect that trail will be biased against low cost and poor borrowers. So we expect greater selection of landless and low cost borrowers in GBL. So these features are likely to generate higher repayment higher repayment rates in trail. But on the other hand, there is the group insurance feature of GBL, where if one farmer is unsuccessful but his colleagues are successful, then they pay off his loan. So that generates an effect in the other direction. So the net effect is hard to predict. The effect on borrower incomes are also hard to predict. With regard to take-up rates, we expect lower take-up rates in GBL, owing to a variety of features of the group loans which borrowers typically dislike. They do not like the joint liability, they do not like the group meetings and the savings mandates. Now, let me give you some of the empirical results. So let me start with the loan details. As you can see here, for our sample, 62% of loans are from informal lenders and 5% from family or friends. A very small proportion is from banks or co-ops. And you also see much higher interest rates on the informal market, around 26%. The average duration is about 4 months, and most of these loans are not collateralized. And in contrast, the loans from more formal institutions, co-ops or banks, have lower interest rates, 11 to 15%, and the duration of those loans are much bigger, but on the other hand, they are mostly collateralized. Now, with regard to selection, one can gauge whether it is the case that safer and more productive borrowers are recommended in trail. So the first regression here gives you the interest rates paid on the informal market in trail, and you see that trail agents, when they recommended clients from their own clientele, these these borrowers were paying 7% lower interest rates on the informal market, indicating that they were indeed safer. Whereas when you look at the GBL scheme, those who were forming groups were paying 5 percentage points higher on the informal market, indicating that they were less safe on average. And when you compare trail versus GBL amongst the eligible or recommended people, the GBL borrowers were paying higher interest rates of about 6%. So this is confirming the first set of predictions that we had developed. This is the selection across different land holdings. And again, as we expected, the landless were more likely to be able to access GBL. Whereas in trail, you see a slightly higher likelihood for people owning between a half acre and 1 acre of land being recommended. Loan repayment rates, this is across 6 cycles, each cycle lasting 4 months. And you see in the beginning, the repayment rates were pretty similar and above 95%. But by the end of the sixth cycle, which is the end of 2012, the repayment rate in trail was significantly higher than in GBL. The loan take-up rates are uniformly higher in trail compared to GBL across the 6 cycles. The continuation rates conditional on eligibility are also substantially higher and diverging between trail and GBL. So these again confirm the expectations that the trail loans would be more popular. Now finally describe the treatment effects that we have estimated, which is comparing the outcomes for the treatment group and the control one group, that those who were recommended or had formed a group, but just by the lottery did not actually end up getting a loan. So you see a pretty substantial treatment effect on the size of loans for both trail and GBL, a bigger effect in trail, 8,000 rupees expansion, which is about a 3 times expansion in the scale of borrowing. And the cost of borrowing also falling by more in GBL because, as I explained earlier, the GBL clients were paying higher interest rates on the informal market. Effects on potato cultivation and output, you see a significant expansion in acreage, about 1/3 in trail. Some of it was these small poor farmers leasing in land. And there's about a 20% increase in output. Whereas if you contrast this with GBL, you find some effect, but it's not statistically significant. Next, the effects on cost of production, revenue, and value added, you see is statistically significant and fairly large, again about 20-25% expansion in the cost of production, in revenue, and in value added. And of course, value added differs from profit by not including some cost of family labor. But the effect on family labor is positive and insignificant. So irrespective of how one values family labor, there is a significant increase in farm income from potato in the trail treatment, but not in GBL. The effect on different crops, you see the significant effect in potato, but the 3 other main crops, sesame, paddy, and vegetables, you do not see a statistically significant effect for either trail or GBL. So the effect on total farm income is again of the order of 25% in trail, whereas it's almost zero in the case of GBL. The implied rates of return, just to get an idea of the productivity of the farmers that were selected, we estimate these in 2 different ways, with bootstrap direct estimate and an instrumental variable production function estimate. And in either case, for potato as well as for total farm income, you see extremely high rates of return for the farmers selected in trail, of the order of, in the case of potato, of exceeding 100%. And in the case of the IV estimate, it's 72% for potato and 103% for total farm income. And comparatively, the rates of return in GBL are much lower and statistically significant. So let me summarize the results. We designed and implemented Trail, a new way of lending to poor farmers. and compared its performance experimentally with group-based loans. Trail succeeded in inducing a significant increase in the cultivation of potato, the main cash crop in this area, and also in borrower incomes. It achieved repayment rates in excess of 90%. The corresponding outcomes for GBL were substantially lower and statistically insignificant. And Trail also meets RBI goals of lending to poor farmers at low interest rates, using a suitable variant of the business correspondent business facilitator mechanism. So let me conclude with some policy implications. Our results indicate the value of providing individual rather than group liability loans to meet higher growth and inflation control objectives. On the other hand, social and poverty reduction objectives of ensuring access of landless and low cost groups could be better served with group based loans, which is pretty much the current SHG model. So, both kinds of loan products could in fact coexist. And our recommendation is to supplement the SHG model to include a component which provides individual liability loans similar to Trail. Okay, thank you very much.